All right, everybody, welcome back to Cashflow Chronicles, and welcome everybody that's joining over from Finance Junkies. We're back with Kris Patel, and we are going to be talking about earnings, banks. Kris is going to educate us on regional banks, what the hell's going on there, and whatever other topics come up in the chat. So if you guys have any thoughts, feel free to give us a idea as to what's going on there. Kris, anything before I kick off the intro?
No, man, it's just this earnings season has been good. There's a few companies that I've had that really hit it out the park, which are making a lot of sense. So yeah, I think this is good.
Yeah, maybe we'll end up talking about one of our favorite picks that turned around a little bit this afternoon, up like almost 5-6%. But anyway, we will be back after the intro.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.
I will say, if we continue this shindig, we need to hire good old Carlos to make us a good old intro, because I know you've been saying it, but my intro skills are no bueno.
That's fine. That's fine.
So, how are things, brother? What do you want to kick off with?
My portfolio is doing really well, which is good.
Yeah.
My sense of the general economy is not. I think we are in a very weird position where we might have a banking crisis ahead of us. And the market's not really, the market right now is focusing on earnings. So it's kind of shielding a little bit away from the actual problem. But let me just bring up something really quickly, because
while you bring that up, I guess I want to take a quick step back. So for people that are unfamiliar, you talked a little bit about on FJ Finance Junkies, a little bit about New York Community Bank. The question that I have for you, maybe to help give some clarity, I think the FOMC said there's no more short-term lendings that they're going to give out to their balance sheet to help shore up some of these regional banks. Is that what you're referring to when you're saying you think there's going to be another banking crisis? Because about 9 to 10 months ago, in the March timeframe of 2023, we saw everyone freaking out about regional banks. And I guess my question to you is how is that different from what we're seeing with NYCB?
Okay, so there's,
and if you think what you were going to bring up explains it perfectly, then ignore what I said.
Yeah, no, there are two main differences between last year and this year. Last year they set up something called the BTFP, where you can take your assets, put them with the Federal Reserve, they give you liquidity. You use that liquidity to run operations. That's, and basically all the regional banks did that. They took money from the Federal Reserve. They were able to shore up their balance sheet so that if they did get hit by a run on the bank, they would be fine. They would be okay, because they had the liquidity. BTFP supposedly is ending in March. But it's not ending right away. It just means that they won't make any new loans.
Oh, they said it was ending in March. Okay, I missed that part. Very good.
Yeah. So if you take out a loan with them, you have a year to go. So I think a lot of people are getting that a little confused, I think. Or maybe I'm getting confused. I don't know. But the way I see it is that it expires. The program expires in March. So that's one thing to just keep in mind. So it's not so much of a crisis for this year. It's a crisis for next year. More important than that, though, is that when you do take this money, you're essentially creating a loan. So it negatively impacts you as a bank, because on your balance sheet, it looks like a giant liability, right? So it's not like the government's giving you free money. All they're doing is just saying, hey, listen, instead of having to borrow from Matt and Kris, the average retail, person, you can just borrow from us instead. So they're like,
this is providing liquidity because they don't have a lot, right?
Yeah, exactly. So, that helped the regional banks recover last year. So if you look at the regional banks, they all started to do somewhat well. The problem is regional banks, they're loaded up with a lot of CRE assets. So they have a lot of commercial real estate assets on their balance sheets. And as you can see, a lot of people are very negative on commercial real estate. There are definitely a few loans that are really terrible out there. Like, no one is saying that every single commercial real estate loan is good. But the problem is the fear in the back of everyone's brain is that commercial real estate is going to collapse. And if commercial real estate collapses, what's going to happen is the owners are just going to basically hand over the keys to the banks, which are regional banks. A lot of regional banks have commercial assets. And basically the bank is going to have to fire sale the asset. So if, let's say, you lent someone 5 years ago $100 million to buy an office building prior to COVID, and they were paying on time, they're paying their mortgage, everything was good. 5 years later, when it comes time to refinance, number one, the rates that right now exist are much higher, which means that you have to charge higher amounts to that person. Well, that person says, look, I don't even have the occupancy right now to pay you the rent. So how am I going to pay a higher amount? So you as the bank have to say, okay, either we'll extend it with the current rate, or we will take the building back. And the problem is, if they take the building back, they have to put it into something called special servicing, and then they have to fire sale the damn thing, because now you're trying to sell an asset in a market that people are not trying to buy. So, eventually someone will buy it, but it won't be a price that you lent that money for. So if you lent $100 million, you might get 50 million. That means that now you have to eat a $50 million loss. So a lot of banks are saying, look, my book value is X. In essence, though, if you did mark to market, like if you tried to sell those assets in the open market, you would get 50 cents on the dollar, because the current environment is just really poor for commercial real estate. So that's problem number one. Problem number two is that even if you do have certain things that are not impacted by the quality of the underlying assets, like let's say multifamily housing, where it does generate income, a lot of these loans were issued at 3%, at 2.5%. So those are sitting on your bank, like you're borrowing at 5.5 or 5.25, and you're only getting back 3.25. Now you can sustain that for maybe a little while, but you can't do that indefinitely. So that's the other problem that you're running into. Now, if the Fed starts to lower interest rates, that's fine, because now they could actually probably sell the better quality assets in the open market and generate the liquidity that they need. But right now, there's just not a lot of money for asset acquisitions. So what I have been seeing is the vultures lining up on the sidelines, like myself, who have liquidity, that are saying, hey, I can buy some stuff up on the cheap. And if you can buy up stuff on the cheap, that's great, because that means that you get instant profitability. So imagine right now you have an office building that was appraised for 100 billion 5 years ago, and you're able to buy it for 50 million. That means even if you took a 25% haircut on the building, you're still up 25. So, so you're in a really good spot. So I'll actually highlight one thing real quick. Did you see this thing by SL Green where they were talking about this, about setting up money on the side specifically for acquisitions of this?
No, but I'm excited to hear it, because kind of what you're referring to, right, is I was looking at some people that were looking about this or mentioning this on Instagram. I don't really listen to a lot of Instagram reels, but this one actually was pretty intelligent, and it was flashing up 4 or 5 different real estate buildings that were purchased over the past, somewhere in 19, somewhere in 20, somewhere in 21. And it showed exactly what you're talking about. Some of which were bought for 40 million. Now they're being sold for 25 million. Some were bought for 100 million, and now they're being sold for 60 million. So like, these haircuts are real. And while you're pulling up what you're going to pull up, I have some quotes just based off of something from Reuters, which is talking about basically exactly what you're referring to, which is the commercial real estate loans and how much regional banks hold. And I have a quote here from an analyst from JP Morgan Private Bank. Compared to big banks, small banks hold 4.4 times more exposure to United States CRE loans than their larger peers, meaning the JP Morgans and the cities of such. And that was stated by a new analyst report from JP Morgan Private Bank. And they continue on to say, within the cohort of small banks, CRE loans make up 28.7% of assets, in regional banks compared to only 6.5% of big banks. And so going back to kind of what you're talking about is this is a huge part of the balance sheets of a lot of these regional banks. And so for that, it's going to be extremely tough going for them. And will they have the ability from a regional bank perspective to withstand this sort of deterioration of their balance sheets and be able to come up with the cash? And I heard you talking a little bit about FJ. And yeah, I'm curious to see what big banks will benefit in the long term from this.
I mean, the only one that I can think is JP Morgan. That's about it, man. You know, I don't necessarily think there's a lot more banks that can do it. What's more interesting is this right here. You see this? Equity raises right here. Brookfield wants 15 billion for real estate bet after stumbles, asset management. So basically what's happening is there could be there could be fire sales happening in the office CRE sector, which means the ultimate losers will be the banks, and a lot of these companies will be able to pick things up at 50 cents on the dollar or negotiate there's like such an internal working thing, man. It would take me hours to explain how everything is happening, but basically the vultures are lining up on the sidelines. You know, because when the elephant lands and dies, they're gonna have feast. That's what vultures do. So
do you think that the transition? Because there's been rumblings as well. I don't know the answer, which is why I'm asking the question, because you're pretty more well versed on this than I am. The only thing I'm excited about is just refinancing several of the properties that my family owns and I own personally. So I'm excited about that piece of it, but going back into the personal real estate side or more the residential, a lot of the companies you just brought up, the Blackstones of the world and some of these other asset managers, they've been fiending up some of these residential real estate properties. Do you think that the tide will turn where they start wholesaling some of these residential properties because they've been able to get so much money out of them, and then they'll take this opportunity to run when there's blood in the streets to the CRE market and do exactly what you're talking about, which is kind of reshuffle their portfolios to get an absurd amount of allocation? My fear is, though, are we going to continue in this path of, work from home sort of trend over time? I'm not saying it's, there's two kind of headwinds that I see with commercial real estate at the moment, which is AI, and then also just the normal work from home sort of culture. I know that it's been very different over the past year. It's not like we were back in 2020, 2021, where we were kind of forced with lockdowns and everything to work from home. But you have a lot of these more rural, suburban sort of commercial buildings that aren't as prolific as, say, what SL Green has, right? They don't have the trophy properties of an SL Green. So I guess I'm just kind of posing that question to see if you could add some color to it, because I don't know. And I'm, you have a pretty good head on your shoulders and a little bit more versed on this stuff. So I'm curious what your thoughts are.
Yeah, I mean, even when things collapse, there's still value there. Like if you go back to the 2008 housing crisis, right? It impacted different areas of the country in a different way. There's some areas that took almost a decade to recover in terms of prices. And then there are certain areas that recovered within 2 years, right?
Yeah.
So it's very similar to that in the CRE space, where Class A commercial real estate, it'll go down, but not by more than like 5 or 10%. And then naturally over the next couple of years, they'll go back to what they're worth. So you're seeing a lot of rent being shifted over. So companies are saying, hey, why should I be in this Class B and Class C building when I could just go to this Class A building, get all my amenities done and everything, right? And basically pay the same amount that I'm paying for a Class B and Class C. So that's where occupancy rates actually matter. The other thing is, a lot of these older buildings, the older vintages, they're not even technologically advanced enough to host new tenants. So as an example, let's say you built an office building, even if it's in a great location, in the 1970s, 80s, and 90s, before the internet really became a big thing, right? You don't exactly have the server room capacity. You don't have the ventilation. You don't have a lot of the stuff that you need in order to run a proper building today. right? You don't have access for all the wireless endpoints that you have to put around. So all of those older buildings, they need a lot of modification and capital to be put into them in order to get them up to the standard which the newer tenants are asking for. So right now, if you go into an office building and you don't have Ethernet ports everywhere and Wi-Fi endpoints everywhere, what are you going to do? You're not exactly going to be able to get a great rate on from your tenants, because that's what you need for the modern day enterprise to work. You need all those things, functionality. So
Yeah.
a lot of those buildings are going to have to be either converted to residential, which is not the end all be all, because there's a very limited amount of buildings that you can actually convert to residential, because of just how they're structured. Like you need certain things in order to make it work. So let's say you're in middle of Manhattan. Just because you have a Class B building, you can't just say, "Oh yeah, I'm going to convert it to residential." Number one, you need zoning variances. Number two, there's certain regulatory like city ordinances and regulatory standards that you need to have. A lot of those surround like the size of the windows, how many elevators you need, and like a whole bunch of stuff. So it's not as simple as, hey, this used to be an office building, let's turn it into a residential building. It's a lot of things that go on to it. So according to the survey that they did, barely 10% of the city's offices that are vacant right now can qualify to even turn them into residential. So what do you do with the rest? Well, the other option is you tear them down, and build, let's say, high-rise luxury buildings. So if you look at some of the assets that SL Green has, that's the plan. They just say, look, the location is so good that we could just tear the current building down and sell it to a private real estate developer who does like residential. Because if you look at like the rate of like rent in New York City, like Manhattan, it's astronomical, the rents right now. So I'd say you have to be very cognizant of that. But I do think suburban office buildings eventually will come back, but it's going to be like 10 years out. Whereas the cities, they'll come back within maybe a year or two. I'm already seeing a lot of return to the office mandates happening, where right now the dynamic is kind of shifted a little bit, where the workers last year had all the power. This year, the employers, with all the layoffs, they're like, "Oh, you don't want to work, you don't want to come back to the office. No problem. You can stay at home for the rest of your life if you want."
Yeah.
So it's one of those things that right now employers are getting to that position. The other thing is international is already back to pre-pandemic levels, of office occupancy. It's just us here in the U.S. that's a little bit more on the hesitant side of getting back to the office. So I think eventually people will transition back. There's already companies that are saying, listen, 5 days a week or pack your bags. So I think over time, you're going to keep seeing that trend. You're starting to see also occupancy levels starting to recover in certain markets. So I just keep an eye on that. This could be an opportunity. Once again, the best opportunity was last year, but I think there's still some opportunity in the commercial.
Yeah, there's still going to be some diamonds in the rough. I think from my bias, I've been back in the office since May of 2021. I was one of the first 10 people to be back in the office, other than, I guess, the security staff. But in terms of like actual physical staff for UDOC, I was one of the first 10 people, and kind of piloted the program, what masks, etc. And it's been slow, but now I'd say, like, even if you get into the office a little bit later on a Tuesday through Thursday, it's going to be hard to find a parking spot, which hasn't been that way for many, many moons. And so I hear you. We're still working the hybrid model. I go in 4 days a week. I like to work my Fridays from home, but because I like to knock out everything for those 4 days and really just take care of some simple stuff if I need to on Fridays. But that's just me. Like, I like that interaction. I feel like I can concentrate better there. I feel like if I'm home, I want to like read finance articles or watch a MIT or do any of these other things that would help kind of my personal sort of finance stuff, which is what I focus on when I'm at home. So it's hard for me to kind of like have that split, but I recognize some people are much better about being able to manage that. But that being said, I think I'm observing it a lot as well. The highways are back to kind of what I was expecting kind of what I saw before I left for overseas in 2019. Back to that. But I think going back to what you were talking about, specifically Houston based, but I think this could be applicable everywhere because Houston's a very sprawling city, right? So it's almost like a kind of like a suburbia, if you kind of look at it that way. It's like one big suburb almost. The thing that I observe is because there's so much land in some of these areas, unlike New York and like Philadelphia and stuff like that, so much land out here in Houston and Texas in general, that generally speaking, they just keep having the city sprawl outwards. And so back in the day, when they built a lot of these complexes in the 80s and 90s, like the building I work in, it's like a 28-story high rise, but it's in the middle of nowhere. So it's like, now it's starting to get to the point where there's a lot of apartment buildings and stuff being built up. And so it's like the density and the rent and everything like that back in the day was probably smart to go out in the middle of nowhere, get these 20, 30 acre sort of plots of land, build a high rise building. But now that you have all these residential buildings, like that 20, 30 acres, you could put a lot of apartments on there. And I think a lot of people are starting to look at that being like, oh crap, we're buying this for $50 million, not because of the fact that we want this commercial building, but because it's sitting on 50 acres or whatever it is. And we can knock it down and put townhomes. We could put residential, high rise or medium rise buildings in it. No longer are you going to have these like big sprawling 5-story buildings over here, then a nice like fountain area over here. It's like it just doesn't make sense from a space utilization standpoint. And so I see it personally, and where my buildings are, out here in Houston, it's like 20 years ago, there wasn't a lot of people that lived west of those. And now it's kind of like within the city limits and bustling. And it's like now you just have these big campuses that are kind of in these big residential areas where you have apartment buildings going up. And it's like, I could imagine if you repurpose that land, it'd be very valuable to either put individual homes on it or townhomes or individual townhomes. Anyway, I'm speaking in circles at this point, but interesting, very interesting thoughts.
So I didn't know that Tevis was coming to visit you, man. He said, "Are we still doing bunk beds?"
Oh, what? I didn't read that.
Yeah.
We don't need bunk beds. He can just sleep in bed with. No, I'm just kidding. But no, Tevis is a good dude. We when you guys went to what was it? Not Cirque du Soleil, whatever it was, or was it Cirque du Soleil? Anyway, him and I got dinner, talked about life. He was telling me a little bit about his business. He's doing really well, man. I'm really proud of him with respect to one, how much hustle he's putting into his YouTube channel, and two, with respect to his hustle in general about being able to knock out work. I was excited to meet a lot of people in Vegas. Garcia, TJ, yourself, a lot of people, a lot of cool people. Yeah. Miss Junebug, and I even got to meet Michael Walder. It was a good old time. We need to do it again. But somebody was asking about covered calls. We could answer that question, or we could jump more into the preview of earnings. The thing that I just want to say about covered calls, and I don't want to do a deep dive, is like covered calls is a very broad term, right? You could do at the money covered calls, or like, because I see some people as an example that just missed this huge run up in Palantir because they were at $17.50 covered calls, and so they missed all that upside. And so my question is, is that really, are you being a penny wise but a dollar foolish in some of these cases where you're trying to get too much and squeeze too much, and if the stock moves in any sort of way, you're buying the stock back, and next thing you know, the best thing is I guarantee, let's say some of these people are going to buy back their covered calls for $17.50 or whatever on Palantir. Palantir is going to dip back below $19. The next thing you know, they bought it all this, this money, spent all this money to buy it back, when in reality they didn't need to buy it back at the price that they did, or they end up. So it's interesting. I see a lot of people, being a little bit too greedy when it comes to the covered calls. And I'm not saying what TJ is doing is wrong, but you have to realize, like, what is your investing style versus a TJ or myself? And for me, it's long-term price appreciation of the underlying positions that I have. And so, to me, I want to make sure that my golden geese don't get called away from me. So I like to make sure that when I write cover calls, they're far out of the money, like, and short dated expiries. I'm not writing a year in advance, because hell, you could have a movement of 40, 50% overnight in a stock. In some cases, not all cases. And next thing you know, you're screwed. You're sitting there for a year. You can't do anything. It doesn't give you the flexibility. So I'd rather make little pennies here and there. It might be a couple percentage points per year, but I just want to make sure, if I have shares of Google, I bought it because I think Google is going to a $5 trillion market cap at some point. I didn't buy it so I can write a covered call and get $1 here, get $1 there. I bought it because I think eventually it'll be 3-4x compared to where I bought it from. So anyway, that's just all I wanted to note about covered calls. There's a lot of different ways. And so just like buying stocks, right? You can swing trade, you can day trade, you can invest long-term, you can do speculative investing, value investing. It's the same thing with options, man. It just gives you a little bit more variables because there's a little bit more buttons you need to press. And there's a time component to it too. That kind of puts a stopper on it. So anyway, you're on mute, my guy.
I was going to say, let's take a look at our portfolio, see if there's any earnings that are coming up that are worth looking at on that side.
All right. Let me take a quick screenshot. We did clean up some of these positions, like HCP, EXTR. Oh, this is my Roth. Sorry.
Did we sell EXTR at a profit? Or do we end up losing a little bit?
One was like break even, and one was like still 3-4% profit. I can go back and double check at some point, but we didn't print money on them.
Yeah.
We were up pretty significantly, right? Like, that's the thing, is I think you sold them a day or two before I did. I didn't realize. Yeah. And so I think you were able to lock in slightly better profits than I was. Okay, let me just shut down this so nobody sees my top secret numbers. Share screen.
Tevis is asking, am I still bullish on Verizon? Yes, I am still bullish on Verizon, but via options, not via stock. Like, the stock value, it could go up to 55, which is maybe, I mean, if you want a 20% rise, that's fine, I guess. But for me, I think the options are the way that I made a crap ton of money, and I think that's the way that I'd go. But okay.
Yep. So the yellow signifies that we made a change today. So we got a dividend from Verizon. We got a dividend also from, I forget what other company it was, but it was like $2.85 in dividends. So as we kind of talked about, anytime we get a dividend, we're going to put it in an NEXT. So I put it in NEXT, bought down our cost basis a little bit there. But only other than that, the only other positions that are negative are my positions, Rocket Lab and Bros. TQQQ is up still handsomely, 55%. Verizon's up for you about 12.5%. And it just paid us a nice dividend. So you can put that in your cap as well. Paid us like $2 in dividends. So
Tellurian too. Tellurian, that position's a profit now.
Yeah, Tellurian, that one should be paying us. I think actually did pay us a dividend. Hold on, let me.
Yeah.
In the background, maybe after when I stop sharing the screen. Accelera is up 15. BPYPM, I'm excited about. So I saw some news articles that you had rumbling about those. Celsius was up pretty good today, and I know we've been adding to this one. We're up to 7 shares now. I personally, around the same time as you did, initiated a position, and my calls were up pretty decent today specifically. I would looked midday and I was like, okay, I'm kind of break even. And then I looked at the end of the day and it even was up even more after hours. So I was like, okay, even with just a couple $1 price movement, because I bought mine deeper in the money than you did.
I went further out in the money. I bought mine were $65 calls. Which one did you buy?
I bought the 50s just because I wanted to get basically like $1 for $1. Because I was like, if I'm gonna be writing on this, so I think I bought them for like 19 or something bucks, and so I was like, so I have like a $69 break even, and I'm gonna write covered calls throughout. So I've just
Did you
been
do them
writing.
naked? Did you do them naked?
What, the naked calls, or what do you mean?
No, did you buy them naked? Like you just bought them straight, just the calls, or did you go like did you do like a no, you of course you did them naked. What you did
Yeah,
was you just bought the calls, and then you've been selling
shorter
against
dated.
them with the shorter duration. Okay,
Yeah.
gotcha.
So I'm doing what most people would call a poor man cover call. So I
Yeah.
have the January 2026 is for my leaps, $50 leaps, which I bought for 19. And my hope is on a monthly basis, which I'm not selling for March because the earnings is on the 28th, I think, for Celsius, but I'm slowly
Rob
gonna
is
chip
saying
away.
Rob is like, I went DGen and bought the 75s. You made the smart move. I did the
There, yeah.
65s. The DGen move was the right move. That's how it
This
works.
is the
Sometimes.
thing, right? Like people might be like, "Oh, I want to buy 10 contracts." So this is a problem, and I want to talk about this. I want to buy 10 contracts. Should I buy the 50s? Should I buy the 65 or 75? It's like, no. Figure out an amount of capital you want to dedicate to this position, and then figure out what leverage you want, right? Because if you go for $50, you're only going to get a couple contracts. If you go for 65, you're probably going to get 25, 30% more contracts. If you go for 75, you're probably going to get 50% more contracts than I did. So it's like you really got to figure out what you want and how you want to structure it, because the 75s, if it goes to $90, which I think it'll go to 80, 90 personally within the next 2 years. I maybe I'm wrong, who knows? Most likely will be, because I'm always wrong on everything. But if that's the case, then shit, man, those 75s will probably print some damn good money.
So let me tell you something funny. When this thing dropped off, I was waiting for a pullback. I was like, all right, you know what? Let's take a look. I was able to buy the $65 calls for roughly $12.75. It's like average. I have like some in 13, some at like 12.50, whatever. So my average is 12.75. And I was like, what happened was a calculation in my brain was that the short-term bearishness with Bank of America, I think they missed on certain aspects to this. So usually I'll just open a spread, like just
Right. Yeah.
buy this strike, sell this strike, blah blah blah. So instead, I saw this coming, and I was like, you know what? I am gonna buy the naked call, and then I'll sell the positions against it. And I averaged down, so I have 145 Celsius contracts for $65. So today I woke up in the morning, I looked at it like, oh, it's doing okay. As a just chance, I put in a sell order for $100 strike for 2026 for $8. And I was like, yeah, they're not
That's
gonna
not
get
gonna hit.
close.
That's not gonna hit. Yeah, I would say the same thing. And it hit.
An hour later, I woke up. This fucking thing, da 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 da. Because Fidelity will hit you with alerts. They were all bought. Someone bought them for $8. So I'm like, I did the math in my head. I was like 165, 100. I was like, damn, man, that's a lot. So I got so much of my capital back. So I locked in a lot of those profits. Now the funny thing is, I may end up degenning if this does pull back again and just buy some $75 calls and do the same fucking thing again.
My question is going to be is like, do you have a limit order set to buy them back at, say, because I'm going to look at if I can see the hundreds now. So the hundreds are like $7.45 to buy. Oh no, that's to sell. So to buy back, they're like $7.90. Yeah. So I mean, do you have it? So like, would you want to buy them back for $4 and try to see if you can like keep playing this game? Because I don't know how much it was.
Nah.
Yeah.
Whoever. I'm good. I'd rather buy the ones. I'd rather buy the 75s, to be honest, with the liquidity that I have now, and just double down, because I think this thing has a lot of I think this thing has some legs to run. So I'm bullish on it overall. The only thing is, when I was looking at the prices, they were pricey. A lot of people said to me, Kris, this is kind of crazy. Like, you're paying a lot of money for these contracts. And I was like, yeah, because if you think about it per contract, that's when I bought it was almost $1,300. So multiply 1,300 by 145. It's a lot of chunk. That's a lot of money.
Yeah.
So I had the liquidity anyway, because I've been stacking it on the side because of because of just how my anticipation that there were some opportunities that were coming our way. I just didn't think that this was going to be one of them until recently. So yeah.
Yeah, I mean, you added pretty significantly when it kept dropping, because I added, I think when it got to 53, probably a week and a half ago. And so I wanted to add more. I'm still trying to sell out over time over Pepsi, and there's one other position I'm trying to eventually sell out over time. And like today, I sold out of some Pepsi this morning to buy more Rocket Lab, and luckily that was a decent move because I got it at like 405 or 407 or something like that. Now it's back up to 426 by the end of the market. So ended up being a decent purchase. So I was able to purchase about another 2,000 shares of Rocket Lab. But yeah, like there's a couple things that I want to. If it continues to be down in the $50 range, I think I'm probably going to end up buying, probably doubling the amount of calls I have. I don't have nearly as much as you do, just because I don't really. This isn't normally how I trade a little bit, but I'm doing very select opportunities for this. Like for example, I did some long. I don't know if I told you this or not. I did some like month-long long calls at the end of October last year. And obviously, we know how the market turned out for the last half of the last 2 months of the year. So I was up pretty handsomely on those. It wasn't a lot. It was like a couple thousand. But I'm trying to figure out if I can do it better than I have in the past. Because in the past, I didn't have, like 3 years ago, I didn't have nearly the education that I do now. And so my thought process is like, if I'm a little bit more selective, rather than forcing a trade, being a little bit more selective, letting the strikes come to me before I automatically just swing it out of the park, rather than trying to force something, then I'll probably make better decisions. And thus far, maybe it has been a hot market, so easy for me to be like, oh, I'm better now. But in reality, it's probably just the fact that you have a good market for this one. So
Yeah. I think there's still some really good undervalued companies out there that are worth looking into. I would say this is where just be selective, and just relax. Like another company that I'm looking at is on on holdings. You know what that is?
like the shoes, or are you talking the
Yep. The shoes, the shoes. Yeah. They're just a little bit harder to value than something like Celsius, which I think is easy because you have a comp in Monster, so you can run the numbers and get a pretty easy way to figure out what the valuation should be, and then you can model out growth. And I think from what I'm seeing, on running shoes, so bullish on them. Tevis, get on here with us, man. If you got some time, bro, I'd love to hear the thesis on that.
Yeah, I'll shoot the invite, just put it in here. But I mean, it's easy, like you said, like with Celsius, it's like it's just coming off a triple digit growth year. Will it persist? That's kind of the question. And then the things I'm looking for Celsius for the fourth quarter is, where does the revenue come in? Does it come in flat? Does it come in slightly above? Which I anticipate it'll come on slightly above, personally, for revenue comparatively to the third quarter, so the sequential quarter. But the thing that I'm also looking for is, what's their guidance for full year 24? Because I anticipate they're going to say something like 75%.
I don't think they give guidance. I don't think they give guidance.
You don't think they do?
I was listening to their Q4 call last night.
Year.
They don't give guidance. So, because I mean, it's a consumer beverage market. It's hard to guide for the consumer related stuff. But analysts are saying 35, 40% year over year growth. I'm like, in what world do you think that's even possible? But then again, I'd say probably close to, for 2024, close to 50 to 70% year over year growth. So if you want to be conservative, you should do 50. If you want to be a little bit aggressive, do 75, and then run the same thing over in 2025, which is probably 35% if you want to be conservative, and probably 50 if you want to be aggressive. So my target would be about 2.7 to 2.8 billion for 2025 in terms of total revenue, and at a price to sales of 8, which is on the low side, you're looking at 2.7 times 8. You're looking at a market cap about 21 billion. So you just divide that up by 231. That's about $93 a share. You know, I mean, that's
Yeah.
like the conservative valuation. So my conservative target is 90, 95, you know, maybe 90. Moderate is 100, 105, and then probably like aggressive is like 115.
We
What's
got the
going
best-
on, Tevis?
We got the best looking
What up,
Canadian
baby?
in the building, man.
How's it going?
Yo,
How's
do
life?
your part. Buy some Celsius.
Yeah.
You know?
What are we talking? We're talking Celsius?
Yeah.
Well, we were
man.
for a second. I want to give people a graphic. So people might be like, oh, well, that's not 100% year over year. But if you think about it, most people know about the rule of 72. If you don't, what it is basically like take whatever, and it doesn't work perfect, but it's around perfect. So it gives you the right magnitude, the right ballpark. So even if Kris is like, oh, they're going to grow 40% the next 2 years. So that means like you'd be like, oh, well, that's only 80%. That's not double. It's like take one or take 72 divided by 40, and that's about how many times it'll take to double, right? And this is really useful if you're looking at like, oh, I'm going to return on average 7% or 10% or whatever. It works a little bit worse when you're dealing with large numbers like this. But if you think about it, even if you grow at 40% next year, the 40% the year after, you double, right? So you don't need 50% for 2 years in a row to double. You only need 40%. So, I mean, things like that, where you're just literally looking at this, it's going to be monstrous. I'm anticipating. I have yet to see something like this. Even when Monster first came out and Bang started getting popular, like this is wilder than that. And I thought before earlier in the year in 2023, I was like, I don't think it'll be that much crazier than it is today. And now I'm just seeing pallets literally at work just disappear. The shelf at the end of the day, it like show up at like 8 a.m. It's completely full. By the time I'm there, it's like half decimated. They stopped selling Monster energy drinks to load up on doubling the size of the Celsius part in our commissary downstairs at work. It's insane. Tevis, anyway, I'm taking over the airwaves.
Whoa, but
I want to hear
before
your
anything,
beautiful voice.
Tevis, that was a great interview with that guy from Dumb Money. That was awesome, man. That you hit it out the park.
Which guy?
Was it Dumb Money? Not
No.
Dumb Money. Sorry. With Jonah.
Jonah's
That was a great interview.
Yeah,
Great interview.
he's really the guy that turned us on to Celsius. I forget when it was, like October, November-ish. And after that point in December, I had a chance to go down to Florida and then try out the drink. And I came back to Canada with a couple of contraband crates, and now they're available. I haven't been able to find them in stores here yet, though. I heard Costco is like the spot to get them, but that's like my mission over the next week or so is to stock up. But look, I think at a high level for Celsius, right, analysts have them at 39%. And you might be thinking, oh, wow, that's really low. The thing is, you have to keep in mind is they're coming up against some pretty rough comparables. And that's going to get harder and harder for them to keep up those high growth rates when you compare the fact that, what were they up like 200%, something ridiculous? They're up triple digits, basically. And so, but even that, I think that they're going to come in. I think Jonah made a post about this saying he expects 55% on the back of that Pepsi distribution network, on the back of new channels and like just Canada in general, international expansion. I think if you think about this, right, like Monster's what, 50 billion, Red Bull is like 18, 17 billion euros, something like that. And they're growing less than, I think Red Bull sales were up 3% year over year, and then Monster was up like less than 1% year over year. They're flat, basically. The industry as a whole, like energy drinks, are growing about 10 to 12% year over year. And so this thing is an outlier by a country mile, And so even if analysts have them at 39% and they beat that, like you have to sort of come up against those tough comps, and the market has to sort of understand that, hey, you can't just grow 200% compounded every single year because that's just ridiculous. And right now, what Celsius is like 10 billion, 13 billion, something to that effect. But look, man, I think the cool part about Celsius is that they're only 10 or 15 billion roughly, and they haven't even tapped into Europe yet. They haven't even tapped into Asia yet. Like they're just tapping into Canada, and so and even in the US, like the penetration there is ridiculous. Like they're supply constrained, the demand is off the charts. We've all seen that, and I think that similar to on running, and we can jump to that after. It's one of those things where I heard about the product before I heard about the stock. And I think that that's an important distinction.
Yeah. I do have a question for you. I mean, I haven't done as much due diligence on Celsius from an international perspective, but I know they are in some markets. Has it just been a slow rollout to the reason why they haven't grown 100% year over year like they have in the US? Or
Distribution.
Was it just tests? Yeah. So it's strictly the Pepsi distribution hadn't expanded internationally yet. Is that what the real?
So I'm not like super, like Celsius is not what consumes my time. So I'm just still like learning up on them. My understanding, and I could be wrong on this, is that Pepsi hasn't fully taken over all of their distribution yet, but that's the direction that it's trending in. And then the other thing to consider, Matt, is that like they have a lot of opportunities still in the US to grow.
Yeah.
I mean, why would you rush it for international expansion when you're
you and I talked about that when you and I last chatted.
So,
you were like, why would you focus on Canada when you still have to focus on the United States, which is literally 10x the volume?
Dude, Canada is 35 million, 40 million people. Like that's a state in the US,
Which in American size, as you compare the dollar to the Canuck dollar, it's like what, like 2 people in Canada? Yeah, it's like.
So I will provide the color in the background because I did a lot of homework with this. If you're on the Patreon, you know that I did a lot of homework.
Yeah.
But the story for Celsius is like this. They have been around forever. All right. It's not like they just came out yesterday and blah, blah, blah. They were around for a long time, except one of the key differences that they started to really do about 3 years ago is that they started to really market their product more towards younger folk looking for an alternative to sugar, right? Sugar right now, there's a war on sugar happening in the background. I mean, it's just how it is. So if you look at your traditional energy drinks, they're just loaded up with tons of sugar. So now you have this consumer that's trying to get away from these really sugary drinks, and they need an alternative. So these guys realized that very early on and said, you know what, we are going to use this as the marketing push, that we're going to say we are the healthy energy drink. How healthy they are as an energy drink is debatable. All right, let's just get that out the way. Some people say the energy drinks, because of the level of caffeine that's in them, they're not healthy. Bro, I know people that drink like 4 cups of coffee a day, which equivalates to 1 can of Celsius anyway. So, and they've been drinking it for like the last 20 years. So there is definitely some controversy around that. The other controversy is some of the products that they use in there, namely sucralose, which is an alternative to sugar, which some people say that actually destroys your gut microbiome. Hasn't necessarily been proven, but this is what happens. You're always going to have the incumbents that challenge the new product. But if you think about all the people that are just like, hey, listen, I know smoking is going to kill me, but they still smoke, right? I know alcohol is bad for my liver, but they still drink. Why? Because there's an end point, an end goal. So a lot of people, they're using this more as a bridge and a fitness drink rather than just drinking it as just to get energy. I mean, you can use it just to gain energy. So I think the market originally has developed around that. Now, Celsius had to do a lot of private distribution deals so that this way they could be present. The back of a consumer product company is not, believe it or not, it's not, the profits are not generated just by the product itself. You also need to put it in front of the consumers. Now, what does that mean? That means that you have to work with distributors, get your product on the store shelves. You need to get it on Amazon. You need to get it into Costco. So they were pretty much doing all of this stuff by themselves, working with the distribution, working with all the channels to get this done. Now, in comes Pepsi and says, look, we think this is a growth market. We have this marketing machine behind us. We have distribution all over the globe. If you partner with us, we will take you to another level. And this is the same thing that happened to Monster Energy, I think back in 2015 or 16, where Monster was trying to do its own distribution, but then Coca-Cola just came in, or they reached out, whichever one, and they were able to say, look, we have a global distributor. We already have trucks, Pepsi trucks. We already have coolers that we own around the country. We can provide you all the logistical support so you guys can purely focus on the product, right? That's the key. So if you look at Celsius, they're focusing on the product and the marketing. Pepsi is taking care of the logistics. Now, last year, you can't just say to your current distributors, hey guys, bye, that's it. Like, we're going to use Pepsi now. Good luck. No, what you have to do is usually you have to get return items from them, because you already distributed products to their warehouses, so you have to get those back. You also have to pay them, because if they have an agreement with you to supply you for the next 5 years to do your distributions, you need to pay them up front to say, hey, listen here, take the breakup fee. And so a lot of those things were amended last year at the end of 2022. So this deal with Pepsi only came around in 2022. Now, the thing is, this distribution deal with Pepsi, it started to take effect in 2023. Okay, just started. It doesn't mean that they had it right away. There was usually, what you have to do is you have to build inventory by taking all the product from the factories to the warehouses that Pepsi owns, and then Pepsi does all the logistical work in getting it to the end users, or the end like the stores and whatnot. So that is what was happening in 2023. The pure focus for Celsius right now was the North American market, because they wanted to get as much saturation and penetration there as possible. The strategy that they have is something called drill deep strategy, which is actually a very interesting business use case. What they do is they select a market. So one of the markets that they selected is in their home state, which is in Boca Raton in Florida. In Miami, they just said, we are going to overwhelm the competition. We are going to just be fucking everywhere, to the point where all anyone talks about is Celsius. We'll do all of our marketing. We'll do all of our stuff. While these other guys are looking to market themselves all across the country, we're going to concentrate on our core market. And we are going to become so popular in that core market, everyone else in the country is going to say, hey, what's going on in Florida that everyone's drinking the Celsius? So that strategy is working out well. So they've been able to get a lot of influencers on the boat, and it's purely marketing. They're really good at doing the marketing part of it. And at this point, they are now on the top list for all people who are, in that consumer space. So now that they've got the brand, more and more people are discovering it. There's a level of switching that's happening where market share is being taken away from Monster and actually taken away from Red Bull. But more importantly, and I think this is the part that gets underreported, is they're actually taking market share from other traditional caffeine providers, things like Starbucks. I mean, if you think about it, you're a 22-year-old, you can't afford $8 lattes, but you can get $1, $2 Celsius. If you buy it wholesale from Costco, get it for $1, $10, $20, keeps you energized all day long. Which one are you going to go with? So that's one key aspect. Another one is that they did not ignore the female demographic. Energy drinks like Monster and Red Bull have traditionally been a lot more skewed towards the male demographic. Celsius is taking an approach where they're saying, look, we know that women and females in general, they're a very big untapped market that these guys are not focusing nearly enough attention on. So if you look at a lot of the demographics between the people who drink Celsius, it's pretty split down the middle, which is half and half, which is actually surprising. So if you think about it, lattes are $6, not $8. Come on, man. You know what? I don't know what you get in your lattes, but the ones that like we have here in New York, sometime in Atlanta, they're like $8, with taxes.
Chris is rich.
I'm not rich. I'm just saying I think it depends on the place where you are.
Yeah.
So whatever.
Yeah,
the point is, it's a lot more than a can of Celsius. That's all I'm saying. So I think their core demographic is split down the middle. So they've been able to attract a lot of people, not just from Monster and Red Bull, but from other energy providing beverages also. So like coffee. So that's coming in. The other thing is you're also seeing market share being taken from Gatorade and Powerade, because they're not only marketing themselves as an energy drink, but as a fitness drink. right? So they're taking share from even that portion. So I would say the total addressable market for Celsius, I think a lot of people are looking at a purely based, oh, it's an energy drink. I don't think so. They're going a little bit further out where they're saying some of our business is definitely energy, but some of our business is also hydration, sports hydration, and also fitness. So I think there's a combination of things that are happening in the background, which lends me to believe that the growth rates that are being projected by the analysts are under what is actually going to happen. And I think conservatively 50% next year is a very real possibility, with maybe a little bit more than that. I think if you ask Jonah, he'll probably say it's like 75, 80%.
So I want to ask a question. So you noted a little bit about how it takes some time to transition to Pepsi being the full distributor. My question to that being is, like you kind of alluded to, you still have other contracts in place, people have to get paid, etc., concurred. So from 2022 to 2023, there's obviously going to be some slippage, right? You're not going to get the net margin that you want to associated with that. Do you think in 24 we're going to see an increase of ops margin associated with the organization based off of now maybe that you're fully, and we have already seen ops margin grow massively, right, over the past several quarters, but I just want to know if it's going to continue, or if this is like, because I was doing this with Palantir where I was like, oh, okay, free cash flow margin is going to be X. I anticipate in the next quarter it's going to be X, and next thing you know, it jumped 4%. So it's like, I'm curious if when you're looking at it, I know revenue will be the main driver, but adding that additional couple percentage points on the bottom line will also truly make this thing a monster when it literally comes to evaluating from a forward PE perspective. And then before you answer that, I want to give people some color about the first 9 months, because we don't have earnings yet, right? This is February 28th. The earnings come out. So for first 9 months, U.S. growth was 108%. Versus the first 9 months in 2022. In other places like Europe, it was 34% compared to the first 9 months in 2022. Asia Pacific, which they state specifically in parentheses, consists primarily of royalty revenues from the China licenses, contributed 44% growth in the first 9 months compared to 2022. So basically, all that being stated, and then there's a very small $4 million of revenue for the first 9 months in 2022 from other international markets. So going back to what Tevis has kind of said, international is barely touched. To give some color to that part, and then I want to get back to the net margins and stuff with that. Overall, these are the first 9 months of this year's revenue from these 3 other international locations outside of the US. We're talking 31.6 million for Europe. We're talking 4.1 million for China. We're talking 4.3 million for auxiliary other countries that are not named in the 10Q. My question to you guys is, like, where do you see this showing up next year? Is this going to continue to grow at 40-50%, or do you think they're going to hit some sort of 100%, 200% sort of growth rate within the next 2 years? Not saying it's 200% next year or anything like that, but in the coming several years, how do you see revenue growing?
Can I tackle that first, Chris? Look, I think the overarching question that we're trying to answer is Celsius a good investment at this point? And I think that a lot of investors might shy away because of the trajectory that it has. If you look at, like a 5-year chart, it looks absolutely scary and you feel like you missed the boat. But from everything that we've been talking about so far, I think the takeaway, just at a high level, is that 2024 has the potential to be a very unique year, a primetime year for this company, because there's multiple growth vectors that are going to be converging all into one. You have the branding aspect, right? The health drink market. You have a virality in their marketing campaigns. You see them all over TikTok, all over social media, all over sporting events and sponsorships that they now have. And so the word is spreading like wildfire. And not to mention that the product also sells itself via the word of mouth. I, tried it for the first time, and I had to, after I saw the caffeine content, I had to limit myself to 2 of these things a day. But the fact of the matter is the product has no aftertaste. And I've tried Monster, I've tried Bang, I've tried Prime, I've tried Red Bull, I've tried them all really. and they all have this like aftertaste. They all taste, you know, weird. And Celsius really was like a very, very light drink. And so I think, you know, Kris hit the nail on the head with the female demographic in general. This is something that can be branded towards that demographic just because of the taste profile alone. And, you know, I myself had to sort of pace myself in terms of like, I wanted to have one of these things with breakfast. So there's also that product aspect, right? So we talked about branding, we talked about product. Then there you layer on top of that the international expansion with Canada, with Europe, and just untapped markets that they're going to have there. And then the distribution model, right? Kris highlighted the history with Monster and Coca-Cola. This is a proven model. Celsius is doing the exact same playbook on distribution with Pepsi. Pepsi has a very diverse network. They're going to put Celsius in all the fridges, in all the checkouts across America, across North America. And so as you see all of these growth vectors converging, I think that there is an inflection point still ahead in 2024 for this company. Like I'm still hearing a lot about the product, less so about the stock. Institutional ownership, pretty low in the stock, right? If you talk about the ownership structure overall, like, yeah, that's a risk. But if you think about this company, what they can do, $2 billion in revenue, can they hit it? Yeah, sure. I think so. You know, 15% margins, let's say, earnings growth over 50%. This thing has a PEG ratio under 1. And so if you think about it, once you put all of those layers of growth together and the catalyst that they have coming up for this company, you'll realize that, yeah, while the stock might look scary over a 5-year period of how fast it's grown, there's still so much juice in the squeeze here because of all of the opportunities that they have ahead.
Yeah, I think that was well said. Yeah, I would love. I keep telling Kris this. It's like I always have something to drink, whether you know it's an energy drink or it's a Monster, and I've really pulled back on the Monsters as of late, and I have been kind of going towards a Celsius or something that's a little bit lighter. Like Reign now is trying to replicate these sorts of smaller sort of can, more fit like. So you can tell that their Monster, who owns Reign, is slightly intimidated by what's going on at Celsius for this more lifestyle sort of brand. And I was joking with Kris. I was like, I would love to be sponsored by like a Ghost Energy or a Celsius or something like that, because
Yeah,
I mean, it'll increase my cash flow like $2 a day.
but it's also just interesting. Just last thing I'll say that, you know, Kris mentioned the, and I know it's like a contrarian point to push back, but you know, if you look at like I'm drinking this freaking thing, right? This thing has aspartame up the ass. Like I think that the American market is so large, and just the American ideal of consumerism as a whole, like Americans, and I mean no offense, will drink gasoline if it's caffeinated and carbonated, man. Like so I just
You're not wrong. You're not wrong.
There's gonna be a market for it.
Well, I was gonna say you were talking about the aftertaste of like Monster and stuff like that. I 100% understand what you're talking about. I actually love the taste of it for some reason. And I get though why some people would not, right? Because it does kind of taste like some sort of like I even joke talking about when you get the blue one, which is the sugar free, how it's, you know, the unleaded version versus if you get the green, that's the fully leaded, right? Like I joke about that shit because it's the truth. You know what I mean? So it gives you that sort of gasoline, sort of like raw, like that's the marketing, but that's also the beauty of what Kris is talking about, because that completely is a huge turnoff, I would assume, for most chicks that are going in to like get a Monster. I'll see chicks drink like a Monster if they're mixing it with stuff or something like that, or like Red Bull. But like, I don't really see them go after an energy drink. They'll go after like a tea or something like that in the afternoon. So this is really helping uplift that sales and opening up 50% of the population for something that previously they might have only had once or twice a week. Now they're able to potentially do it, you know, 6 or 7 times a week. Kris, you're muted.
There's actually a potential for a short squeeze. Did you guys look at the short interest on this thing?
Oh yeah, isn't it in like the 20s?
No, look again. Look again.
So my anticipation, and I'm curious what your guys' thoughts are, is because they know that there's such a large sell-off associated with the insider sales associated with the heirs trying to get out, that they're looking for that opportunity. And the thing that I've been looking at, right? So since August of last year, when these errors unfortunately did pass, the stock has been kind of like in this channel of coming up, coming down, and a lot of it's associated with when are these heirs selling, when are they not selling. So when they're not selling, the stock, just like over the past several days, was able to kind of rise up a little bit, or they sold only at a half pace compared to what they were. And so it's been allowing it to. So if you think about it, if it's been able to maintain the flatness with all this insider sale associated with people trying to the ownership of selling out due to taxes and just estate planning, etc., and it's been flat. Imagine when they finally do get to the point where they're like, we're done. And then also, like you're talking about the short squeeze piece of it, the short is kind of over at that point, right? Because it's going to reverse anyway.
There were a couple of short bear articles that were wrote in 2020. They got absolutely fucking destroyed. Like Edwin from the Bear Cave, he wrote one. There's another one that called Grizzly Research. They did one and they got fucking torn up. I'm talking about just absolute devastation. I don't know what the deal with this giant short interest is. I don't know who's shorting it, but all I got to say to anyone who's trying to short this company, who's net income positive, growing 100% year over year in revenue, improving their operating margins, good luck. Unless there is some sort of fraud that's happening in the background, which I can't see because I see the goddamn cans everywhere. I see the product everywhere, and I see people buying it everywhere. These shorts are going to get their asses torn the fuck up, man. And it'll be fun to see when it happens. That means that, especially with this reaction that we're going to get in Q4 earnings, that could send the stock up really, really fast up, especially if they report better than expected earnings. So not something that I would not. I don't know, man. It's just,
and the
I don't
thing
know
that
why
I'm noticing as well
this.
is like the first thing that my eyes were kind of drawn to were days to cover. But the thing is that number is being skewed because more shares, because of these heirs selling out, are because you see like the volume went from just under 1 million in a day, about 6 to 7 months ago, to now being 3 to 4, sometimes 5 million a day. So if
Let
you
me
think
just
about
show
it in
you
that perspective, like,
let me just show you guys something really, really thinking. I don't know why people don't look at this. You're seeing all these insider sells, right? Everyone's like, oh my God, look, the insiders are selling, everyone, blah, 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 right? No one seems to open up the damn filing and just look what the hell is actually happening. Hold on. Let me just show you guys. Because once you see this, it'll blow your don't say that, man. That's weird. Okay.
I also wonder if we can, just as an exercise after this, overlay the rising short interest, because that went from 30 to 40 with this dude's death in August or September. I just wonder if that's like the thesis.
Well, here's one thing to just look at. You can see here that this is selling, right? This is the stocks that's selling. What people fail to see is, you see this little code right here, number 3, why it's happening? It's right here. Represents shares of common stock in Celsius Holdings sold by CDF upon exercise of call options sold to unaffiliated third-party purchasers on April 12th. Whoever bought these call options from the heirs is exercising them. So it's not like the heirs are like, oh yeah, I just want to sell. No, whoever that party was that bought these are exercising them. Call option that represent the right for the option holder to buy, the obligation of the option seller to sell. So the shares are subject to the option strike price. That is what's actually happening in the background. People are not even like looking at this thing,
So
Did you guys see this
their covered calls got breached to hell, is what happened.
Yeah, they sold covered calls a year out, and whoever bought them, more than likely some institutional holder, they just said, all right, time to exercise these options. And they're doing it in a way where they're doing it very methodically, all throughout the month or last 6 months, whatever. And I think that's going to be the key, right? Because eventually they're going to have, hopefully they run out of call options that they sold. But imagine that you sold all these call options last year, and then the stock fucking blew up.
What were we going to say, Hot Toast?
I'm probably going to buy more this week. Just on that news alone, that the 40% short float, that's wild. I didn't know that. It confuses me a little bit. I mean, it kind of makes sense because this thing's gone parabolic. But I think, Matt, you've been sort of right on the ball with regards to, Celsius has been on a downtrend since the fall. It peaked, I think, 65, something like that. And then it came back
68,
down to
68.
It came back down to the 50s. Now it's like mid 50s. But like, what's happened in the wider market, man? We're about to hit all-time highs on these indexes. Like, the market's been roaring, and meanwhile, Celsius has been it's inverse, right? Meanwhile, in the beginning of 2023, Celsius was flying, and so I do think that there is periodic selling, and that's validated by what we just saw here. So, really, with the analyst estimates being at 39% for the yearly growth for Celsius, I know that there's high comparables, but man, if they beat those numbers, it's going to be nice to see.
So you think that there's a selling because people are saying it needs to grow a little bit more into its valuation. They knew that they were going to have a killer 2023, so distribution was going to step up, etc. And you think that, they say might have been a little bit overrun. So that's why, yes, coupling it with these heirs having to meet their obligations to sell shares, you think that there's also just some profit taking in general that's been going on.
Yeah, well, I think the insider ownership with regards to that huge chunk of shares that the insiders own, I think that's like the biggest, I don't want to say bear case, but that's the biggest sort of pause for me, because they can just dump on retail essentially. But you got to understand that a lot of people got into this stock. This thing went so fast, so so high that a lot of people just got into this at like $4, right? And rode it all the way up. And so, yeah, there is profit taking along the way. But what I do think is that it's now had several months to form a new channel, to form a new base, and to form that accumulation pattern, so that the people who want out get out, and the people who are left are the ones who are there to stay. And so, I think that as we head into earnings, we're going to be primed for another move, up or down.
I agree.
Yeah, $50 seems to be the flavor. I mean, I'll bring up the charts real quick while you guys want to talk.
And then while you do that, Chris, I know that you've been now on for about 2 hours 15 between FJ and this. So, Chris, question for you: Do you have PayPal position, or is it just Tevis?
Yeah, I have spreads on PayPal. Yeah.
So I'm curious to see where your guys' thoughts are. One, give us a little bit of a highlight after this piece, Chris, that you're bringing up for Celsius. Some color on what you think with Alex Chris that happened last week. That kind of flop, I guess wasn't really that exciting. Maybe I'm wrong. Maybe Tevis as a shareholder, or maybe Chris as a shareholder, you guys are more excited about it than what I kind of initially saw, kind of scratching my head. And then two, some thoughts, because earnings are tomorrow. We've had some people in the chat asking about it. So I'll hand it back over to Chris to maybe finish up, or Tevis, if you have any last words as well.
No, let Tevis go while I find this thing real quick.
Are you sure?
Yeah, go for it.
Look, so I think I'll keep it super high level because I don't have like charts or numbers to throw up. Alex Chris has proven himself at Intuit with the initiatives that he's been talking about, like AI initiatives for years and years at Intuit. Roy and I have chatted about this. He has a much larger PayPal position than I do. And the thing is that he got his ass kind of handed to him at that, Shock the World event. And that was his first big sort of fuck up on the CEO stage. And I think that he's really going to come back from that swinging. What I'm looking for in this quarter is a confirmation of that new vision, is a plan as to how they're going to achieve that new vision, because you got to keep in mind that this expectation from analysts is fairly low for PayPal, man. I think that the expected numbers for revenue tomorrow is like 6% year over year, right? And so, this thing, it has Venmo, it has Braintree, it has all of these other avenues, growth drivers, essentially. Yeah, the core PayPal brand is kind of, a laggard, let's say. But, I do think that they're set up well to beat. And Wall Street is right now betting against PayPal. Just look at the price action and how that's been going for the past couple of months. And, I think that similarly with Alex Chris having a lot to prove, he can breathe new life into the direction of the company and into the product roadmap of the company going forward. So we'll see. But I do think that he's going to be much more careful picking and choosing his words after the Shock the World event. That's for sure.
I don't think that it's such a bad thing. And the reason why I say this is because now people are watching. So even though it might not necessarily have gone as shocking the world as people might have said, people have their eyes on it and they know that something's happening rather than PayPal just kind of being in the background now. So you're going to have at least people's eyes on it in the next quarter, 2 quarters, 3 quarters to be like, is this guy still effing up? Or, you know, and I don't think it was really an F up. I think it was more of a precursor of things to come. And so with that, I think it allows people to maybe say, yeah, he effed up, but he introduced so much avenues there that I think that it gives him a little bit of a light to kind of progress forward. And
Yeah.
I think it always these events where you're shifting the company are always kind of really ill received, right? I've seen that firsthand working at UDoc and seen that go, and it's always kind of met with skepticism and very rarely, other than like an Apple rollout, are they really well received.
Yeah.
So I think that to me now it kind of takes the what's the word I'm looking for, mystery off of what he's potentially doing.
Yeah.
And people now can focus on the execution. And if he does, then I think that'll be massively provide a massive tailwind for the stock. Chris, sorry, Tevis, if you want to respond to that.
Yeah, just super quick. One thing I'll say on that is, like, think about it from a market perspective, man. Like, this guy came in at a time when the quarter was sort of underway. Q3, nobody was really expecting. They just wanted to hear his voice on the earnings call and really just, there was no expectations, right? Q4 is really the first quarter that he's fully had under his belt, and people are going to be looking for confirmation of that upcoming roadmap, right? That's just a natural thing. 2024 roadmap, especially after the January 25th, Shock the World event, where he's talking about like AI and how they're going to integrate AI and what that future product roadmap looks like. People are going to be, analysts, the market, whatever, the street is going to be looking for confirmation of that, because this is his first actual, full quarter as a CEO. The training wheels are off somewhat, and it's no longer, oh, well, I sort of jumped into the quarter halfway through, blah, blah, blah. This is actually the first quarter where he has a moment to shine. And I think that, in Q3, going for Q4, the guidance was actually lowered for Q4. And so the bar is set pretty low. And that's why I think he has an opportunity now to come above and beyond. We'll see. The numbers are going to speak for themselves. But I think the sentiment and the guidance going forward and what the vision is going forward, and PayPal just had cuts as well for, they had layoffs in the same week that they announced this new vision. So he is making shakeups. He's also brought in a couple of new C-suite, a couple of executives that he's worked with in the past that are now into PayPal. And so he's bringing in his own troops. He's making cuts to optimize the operational efficiency. He's talking about new product vision. All of that, he now has an opportunity to highlight at the earnings call.
Well said. Chris, do you have that last piece that you wanted to show on Celsius, and then your thoughts on PayPal? I don't have any thoughts on PayPal.
So you can see here that it's basically been bouncing off of its 200-day moving average. I'm not usually a chart guy, just not a chart guy. I usually just stick to fundamentals. But you can see here that it hasn't been able to breach that 200-day. So anytime it's gotten back to its 200-day, it's bounced off of that. So on top of that, the RSI, it's still within a reasonable amount. It's not like over the top in like the 70s or 80s. It may end up getting there again. But yeah, and then just right now is not a bad time to accumulate. That's all I mean.
The MACD also looks a little promising. I mean, I'm not, like you said, I'm not a big technicals guy, but if that is that a black or blue, whatever, if that crosses over the pink, some people might call that a positive signal that it could run higher. And if it coincides with the RSI continuing to run back closer to the 70 range, it could go on a little bit of a run. And if folks are trading naked, right, with the naked, not naked sells, I don't recommend that at all. But if you bought naked calls waiting for an opportunity, you could wait until that gets to a stronger RSI position, to wait to sell that covered call piece of it, right? Like how Kris sold his
Mhm.
100s today. It could be in a place where within 2 to 3 weeks, if that continues to go on a run and it gets to the RSI above, let's just say 75, 80, then that might be the time where you sell that, because it might stay there, right? It might continue up in the RSIs. It could be that strength thing that can continue up there. But generally speaking, once it goes up, it comes back down more than likely in time. So just like you saw, what is that, in September or August timeframe? It stayed up there for quite some time, but eventually it rolls over.
Yep.
Cool. And what are your
Alright, guys.
thoughts about PayPal, or you're calling it?
I'm calling it, man. PayPal is a good company. They're just generating cash flow, buying back shares, but it's going to be a while before they recover. I mean, you got to give the guy some time to execute. So we'll see what happens.
For
If he
sure.
can execute on his plans, maybe PayPal is the greatest turnaround story we've ever seen. If not, on to the next.
That's
it.
plausible. That's plausible. All right, everybody. Well, thank you so much for joining us, Kris. Thank you as always. And Tevis, surprise guest as always. You're welcome here. And if you guys haven't followed Tevis already, I feel bad for you, because he does a phenomenal SoFi stream. And damn, man, you were getting close to 150, maybe even more people in there. So if you guys are fans of SoFi, please be sure. I left his YouTube in the description. Please go ahead and do that. Tevis, you're welcome guest on Cashflow Chronicles anytime. Any last words?
Dude, we're probably gonna go live. We're gonna do like a bootleg weekly. It's a new show we're doing tomorrow. If you want to join, we're gonna talk Palantir. We're gonna talk, because Roy owns 70 or 80% of his portfolio is Palantir, which is wild to me.
Do you know I met Roy, right? I had dinner or lunch with him.
Oh, I didn't know that. Oh yeah,
he's not far from me. So I met up with him and I was like, it's a cool dude. He's got a really interesting background. I'm really impressed by the guy.
Yeah.
He's like mostly, I think if I remember correctly, it was SoFi, Palantir, and PayPal. I think it's like his 3 big positions.
Yeah, I think it's like Palantir's like 70 or 80%, then PayPal's like the rest, and then SoFi is like a smaller position. But we're gonna talk about that, because PayPal earnings and Palantir. He's probably gonna dunk on me for Palantir. So like, hey, man, join, man. It's gonna be a fun time. You got to invest what works for you, what makes you feel comfortable. I'm not gonna dunk on anybody for making money. When is it tomorrow? Oof. Let me. I almost said Slack you. Fuck. Let me tweet you. Salesforce. No, just kidding. Yeah, I got. My question is when is Palantir going to create their own Slack-ish sort of project or product? I kind of want to have it at like maybe 7:30 ish. But Eastern time. I got to ask the guys. Yeah. Canuck time. I can make that. I think I have an early day tomorrow, so I should be home early. It's because Tanner's show is at 8:30, and we don't want to like eat into his audience at all. Understood. And then question for you: would you be interested? I don't know if the Celsius on February 28th. When is that, by the way? Is that a Tuesday? That's a Wednesday. I'm assuming it's after hours, but I don't know. Would you want to do a live stream for that? If it's after hours, then I'll definitely do a live stream. Yeah, before I probably won't be awake until God knows when. I ain't waking up if it's for that shit. Yeah, I don't wake up. I'm not as awesome as Amit. So but like, let me look up when it is, and I'll actually put a hold on my calendar so that I'm not in the office that day. That we can actually do a live stream call, but that should be fun. We didn't get to chat about on running. I was excited about that. Shit, I forgot about that. Okay, next time. This is fun, man. Like 2 times I've joined the stream recently over the past couple of days. It's both times we're talking about Celsius, which is really cool. I like it. My stream or your stream, yours and Kris's. Okay, yeah. I mean, I know you came on the last time, but I don't know we were talking about Celsius. So yeah, cool. As always. All right, man, you're the man. I'll talk to you in a little bit. And for everybody watching, we'll see you guys tomorrow. Cheers.